Didn't get my shirt straight.
There you go. Is your shirt straight? Hey guys, welcome back. Jeb Smith, real estate broker here in Southern California, and backed by popular demand, we have Josh Lewis, Buywise Mortgage, my go-to lender here in Southern California. In fact, a lot of you guys have asked to have Josh back on because we've done a lot of Q&A, and he's able to answer a lot of the finance questions that you guys have that that I don't know the answers to, quite frankly. So we are going to discuss interest rates tonight. We're going to talk about affordability. We're going to talk about the housing market, maybe some predictions as we move into 2021. We only have 2 weeks left of the year, so we're going to kind of talk about the next 2 weeks. But guys, we're here to answer your questions. So do us a favor. If you have something you want us to touch on, you have comments for us, leave them in the comment section there. We'll definitely bring them up and address those. And as always, we appreciate you guys taking the time to watch and participating. So, Josh, where are we with interest rates? So we're 2 weeks left of the year. Tell us maybe where we are, what you're expecting, and how we transition into to 2021.
Jeb, we'll absolutely get to interest rates, but I just want to start by saying thank you for putting on video recording that there is popular demand for my presence so that I can show that to my wife and say there are people that actually want to hear from me. But the interest rates are their best levels of the year. And the interesting part, one of the things we were talking about post-COVID is the 10-year went to really, really historically low levels, the 10-year treasury. And that's not mortgage rates, but they usually follow in lockstep. But at that time, we saw this big spread open. So what we've seen over the last 2 or 3 months, the 10-year is getting higher as people get more confident that the economy is recovering. But despite that, mortgage rates keep coming down because lenders are getting more comfortable with where the economy is and what the market looks like going forward. So we're seeing this convergence where they're getting back to their normal margins. So it's been a little bit interesting that while market interest rates as a whole have gone higher, mortgage rates have gone lower. So we are absolutely right at our best levels of the year, best levels ever. Conventional loans for your best qualified borrowers, no cost at 2.75 at a reasonable loan to value. One of the things I always like to tell people, so let's start with that. So 2.75, no cost on a refi for a very well qualified borrower. If we're looking FHA or VA, those are in the low 2s, 2.25-ish. We've closed our best borrowers in that range. So long way of saying interest rates are great. What I like to tell people is what I'm giving you right now is no cost. The best qualified borrower and no cost interest rate. What you see that shows up in your mailbox on the flyers, that's for the best qualified borrower paying a shit ton of money in closing costs. And the reason for that is if I want to spend $100,000 sending mailers out to people's houses, my only purpose is to get the phone to ring. So an example, I have a client that we just locked, it was 2.75, this is 2.75 no cost, what we did for him. And he said, well, I just got this thing in my mailbox, I can do 2.125. And I go, no problem. You want 2.125? Let's do it. We run the numbers, and on his loan, it was $19,000 to get a 2.125 interest rate. So it really is, it's not a bait and switch, it's just a loss leader. It's hey, how do I make my phone ring? And then let's go through that. So in terms of when I give numbers, you ask what are the interest rates, I'm always going to give you the rates for the best qualified borrower because it's a lower bound. We know that's as good as it gets. And the reason why we don't quote, well, what's a middle of the road? Well, it varies. There's so many different factors. Interest rates vary by loan to value, how much of a percentage of your home you owe. It varies by your credit score. It varies by loan program. So there's a lot of variables in there. So we always want to give you what's your best case, and hopefully you're really close to that. But most people are right there or a little bit off of it. If you have a really low credit score, a really high loan to value, it can be significantly different, but those are where the best case interest rates are today.
Gotcha. So typically, and correct me if I'm wrong, typically stock market goes up, interest rates go up. And adversely, right? So people take money out of stocks, put them in bonds. Typically, interest rates go down. But what we're seeing right now is the stock market's booming, right? We're over 30,000. Interest rates are actually reaching all-time lows as we reach the end of the year. So what do you think's going to happen as we move forward, right? Obviously, we don't know what the hell's going to happen with the stock market, so it's very hard to predict that. But what do we think interest rates do over the next, say, 2 months?
I don't think we're going to see them move much at all. There's not a reason for them to shoot up. What would we need for interest rates to go higher? We would need certainty in what's going on with COVID, and that would give markets confidence that we've reached an absolute bottom and that things will improve rapidly in the economy. So we've seen the vaccine, and that's been positive news, and stocks have traded well off of that. But we don't know how quickly it can get rolled out. We don't know how it's going to work out. We don't know if it does work out, and when it does work out and we get enough people vaccinated, how quickly the economy recovers. So the first quarter of next year, rates are going to remain really low. The thing to remember is that last year, what we were looking at is lenders had more loans than they knew what to do with. So rates were artificially high based off of the fact that they just didn't have any capacity. There was no need for them to lower rates because they were operating at full capacity. Even as rates inch up, once lenders don't have their coffers full of loans, they will get more competitive. And that's largely what we've been seeing the last 2-3 months. You know, you correctly said stocks and bonds compete. When stocks are doing well, bonds generally suffer, and vice versa. But we haven't seen that. We have seen that because what I'm saying is the 10-year has been getting worse. It's been inching up in yield. So bond prices have been going down. Yields on that 10-year have been inching up, not shooting up, even though the stock market is shooting up. But what we've been seeing is lenders getting more competitive because they have capacity and they want to keep their people working. They hired a ton of staff this year, and before they let people go, they'd rather lower their margins on those loans and see if they can keep everyone busy and working through the holidays. So long way of saying first quarter of next year, I don't expect any movement at all. You see a lot. There's an expert in the real estate market here in Southern California. He actually does a newsletter and advises people on what's going to happen. He actually doesn't sell real estate, and he's never worked in the mortgage industry. So we have to question where the numbers come from. But his newsletter this week was explaining why interest rates had to go up next year. Other than an economics degree from 30 years ago, there's not a lot of knowledge behind that. You have to look and say, what would cause interest rates to go higher? It's the threat of inflation, and there's really nothing on the horizon that threatens inflation. We have a lot of uncertainty. We have the first part of the year of figuring out, the last 6 months, what's everyone been talking about? Well, if Trump wins, this happens. If Biden wins, this happens. Well, now we're pretty damn clear that it's going to be Biden, and we know what he wants to do. That runoff in Georgia is not going to be finished till January. No matter how that goes, we're still going to have 2-3 months of uncertainty. Uncertainty keeps interest rates low. And even when we get a little bit more certainty, it's going to be slow, and it's going to be slow to increase. Rates are going to be worst case in the low threes for the next year. So when you look at it, it is what it is. We have low rates. They're going to be good for people who want or need to borrow. It's going to be good for buyers. The biggest thing that we have to look at is what happens in home prices. People are asking, affordability is out of hand. These home values are going up 5, 6, 7% a year. Right. And the thing to remember with that is incomes don't have to go up in lockstep with home prices. You don't qualify for the entire purchase with your income. You're buying it on leverage. So really, if home values go up 5%, a 2% increase in incomes, which is what we're seeing for those who have not lost their jobs, we're seeing 2.5% wage inflation. That is the important number that we're looking at. When we need to determine, is this a stable and sustainable market? What is the percentage of a household income that people are allocating to their house payment? So home prices have gone up, rates have come way down, incomes are still going up. So we're going to see a really healthy housing market this year. The most important thing, in addition to those factors, is the demographic stuff. We've talked about this before. The millennial generation is the biggest demographic cohort since the baby boomers, and they are coming into prime home buying age. So that is going to push the market. And people say, well, that's great. Those are entry-level homes. Well, that pushes the entire market. As entry-level homes go a little bit higher, now the person who bought 5, 6, 7 years ago and is having their second kid and needs a bigger home, they're ready to move up and sell to that entry-level buyer. So it works all the way through the chain. I know there's people out there hoping, wanting, wishing that there was a bubble and we're going to see a lower entry point for home prices. 2021 is absolutely not going to be it. We're going to see more of the same. Low rates, reasonable affordability for those in good income positions, and home prices going up 3, 5, 7%. I mean, I've seen calls for as high as 10%. I don't think that's going to happen. That it starts pushing the bounds of what a healthy housing market is. So if we get another 5% change, it would be a really good number for everyone other than those who are renting and hoping for home values to drop.
No, yeah, absolutely, and I've talked about that in many times throughout several videos about the millennials being prime buying age and what have you. And I think you brought up one interesting point about how we're not seeing inflation, but even then, the Fed came out and basically said that while they're monitoring inflation, they're no longer basing the Fed funds rate off inflation for the next you know normally they don't want it to peak over what 2%, I believe is kind of their number, and at this time they're willing to even let it go higher and keep interest rates low and through 2023 is what they said. So while the two don't move hand in hand, as we've discussed, if the Fed funds rate stays low, the banks are able to borrow money cheaply, chances are interest rates are going to stay low.
The funny part about them saying is they made an announcement that we're willing to let inflation run above our 2% target for an extended period of time.
Right.
And I don't really know what the analogy is. A similarity would be like me saying, I'm willing to date as many supermodels as possible for the next 2 years. There's no supermodels wanting to date me. My wife would not like that. It is not going to happen. We haven't seen 2% inflation for a long time. So saying, hey, we're comfortable with letting it run hotter than that, they haven't been able to get it to that level. So let's work on getting to 2%, and then you can tell me that you're going to let it run hot for an extended period of time. All of the economic knowledge fears inflation more than anything, when deflation is the bigger risk to us in the long run. And Japan has seen periods of deflation. They're 20, 30 years ahead of us, and we are using the economic policies that they have for the last 30 years. And what it has done has led to low growth, low inflation, and very low interest rates. We are going to see the same here in the United States. I mean, people talk about, well, when interest rates get back to normal at 5%, what does that mean for home values? Say, well, what makes 5% normal? What would drive rates to 5%? And what would the world look like? What would the United States look like? We owe 20-something trillion dollars and rapidly heading to 40 or 50 trillion dollars. Take interest rates on a 10-year treasury to 3% from under 1% right now, and watch what government debt service, the amount of money that the government spends on just paying back treasury debt, and it doesn't work. So when something doesn't work and can't work, it's not going to go that route. The government will do everything possible to keep rates really low for the foreseeable future. Probably you and I's lifetime. We're not as young as we once were. I don't expect to see high rates anytime in my life.
No, all good points. So we're going to come back to this, but I do want to get to some questions here. So I got a couple people. Well, we got the first one asking about multifamily. So asking about investing in multifamily, asking about necessary income to cover it. I know kind of the answer here, but I'll let you just address, the question at hand, or give somebody a summary of what the question is.
So,
or the answer rather.
Yeah, and it doesn't matter whether it's conventional or government financing. The simple answer is you're going to, whether it's 2 units, 3 units, 4 units, you're going to live in one unit, you're going to rent the other units out. Now, it's treated a little bit differently on a purchase of an owner-occupied multifamily, in that if you were buying that as a pure investment, we would take 75% of the rents and offset the mortgage payment. Since you're going to live in one of the units, we can't treat it that way. So what happens is, whether let's call it a duplex, you're going to live in one, and let's say both sides are identical. Either one of them would rent for $2,000. You live in one, you have $2,000 coming from the other side. We give you 75% of that, which would be $1,500, and we add that to your income for qualifying purposes. And the 75% is to allow for the fact that you'll have vacancies, you'll have maintenance, you'll have upkeep. So that's just the factor when we don't have a history of what those numbers look like that an underwriter will use. So that gets added to your other wage income, and you're good from that end in terms of qualifying. And in that same instance, we would treat it very differently if you were buying it as a pure investment. We would take the $2,000 from each side. So we got $4,000, give you 75% of that, or $3,000, and we would offset the mortgage payment, which could vary depending on how much you put down. Let's say it's a $2,500 mortgage payment and you have $3,000 of income coming in, qualifying income. We would treat that like a $500 positive that would go on top of your income for qualifying purposes.
No, good explanation. Hope that helps there, Mr. Og Thomas. All right, so got somebody saying appreciate info, fellas. Thank you for tuning in and watching. Someone's asking, can they negotiate interest rates with the bank, or is it, is what it is? So
it's interesting. This is a common perspective from a borrower asking and thinking bank. Banks make very few loans in the current market. So whether you're going to Chase, B of A, a local bank, a local credit union, they have a very small market share. Most loans are made to non-bank lenders. Quicken Mortgage is a non-bank lender. They loan money, but they're not a bank. So it's an important distinction, because the way everyone operates, you could always negotiate with the bank. It's their money that they're loaning out. If you have a long-term relationship with them, you say, hey, I have $500,000 on deposit. I do my business banking with you. Can I get a lower rate? They look at it and they go, we want the relationship. We'll lower the interest rate. So on a non-bank lender, they also can negotiate that interest rate. It's not their money that they're loaning out, but they have a cost for that money, and they loan it out at a premium to that, and they make money based off of it. So a lender can always negotiate the interest rate. For us, we're a broker, so I have 20 different lenders. There's 200 different wholesale lenders that I could send the loan to, 20 that I work with on a regular basis, and each of those offer different rates. So my job every day is to shop and find the best rate among all of those from a reputable lender that's going to have good service and a good experience for you. So it gets funky when you start talking about it in those terms, but in general, yes, you can always negotiate the terms. What I tell people, it is always important to get good terms on your loan. Anytime it's a recipe for disaster when someone tries to squeak out the absolute lowest rate. If you need to get brain surgery or heart surgery, you wouldn't seek out the lowest cost surgeon. You would seek out the best surgeon. And if you found 2 or 3 really good ones, you would take cost into account. And that's the way I would look at it with a mortgage. Cost is important. You want to get a good rate, low costs. Yeah. But I would also want an expert doing that service for me. It's the biggest debt you're going to ever take on, the biggest purchase of an asset you're going to take on, and you need experts guiding you in that process.
And not to mention, the barrier to entry is very, very low.
Very low.
Just so make sure you're dealing with somebody that's experienced, whether you're buying a home, getting a loan, whatever it is. It's, and everybody is becoming a real estate agent and mortgage person right now, just because the market's done well, just FYI. So
and Jeb, a thing to remember, one of my favorite tips and tricks is if you're talking to someone about a mortgage, any communication they make with you, their NMLS ID number has to be included there. You go right to Google, you plug that in, you look it up at the CFPB's website, and it will give you a 10-year self-reported employment history. And in this current market, when you have non-bank lenders with massive call centers doing a ton of loans, they are taking people from 24-hour fitness, putting them through a 2-week training, getting their licensing, and then throwing them on the floor as a loan officer. But you can see that when you look at it. There are people who come from other industries that are good at selling and know nothing about mortgages. And you may have a good conversation with them, a good rapport, feel good about them, and they don't have any knowledge or expertise. So the good way to make sure that you don't get on the wrong side of that, go look up their NMLS ID. Hopefully you see, and they've been in the business for 10 years, 15 years, and they're true experts. And you can do that in most states with your realtor also. You can see how long they've been licensed. It's hard to see transaction volume. I think you can do that a little bit through Zillow, but I'll just research the people you're looking for. There's a lot of people you connect with and doesn't mean they're an expert and they're going to help you along that line.
No, absolutely. Yeah, well said. So same gentleman, I believe, asked a question about a first-time home buyer, credit score 775, 5% down, conventional loan. Is it better to find a loan or let your realtor choose one? So, I mean, I'll speak on this just because As a real estate agent, if I have somebody come to me that hasn't been qualified, the very first thing I do is work on getting them qualified. Now, I ask them if they have somebody they know, trust, that's been referred to them, and if they do, I tell them to get a quote from that person in most cases, and if not, I ask, can I refer you to my lender, and I tell them why I'm referring them to my lender, and most of the time it's because Josh is typically that person, and it's because I know he's going to do a good job. He's going to take care of the clients. The communication is going to be great for those, for the buyers in that case, as well as on my side. And, I can say in 10 years of doing business together, I don't know that we've ever had a deal fall apart, knock on wood. So I know what to expect. And so I would tell you, if you trust your real estate agent, get a referral from that real estate agent. But that doesn't mean that has to be your only referral. I mean, I'll tell Josh straight up, hey, look, I told these people that they should get 2 quotes. And I think Josh would tell you that that's probably the best way to go. Maybe get a couple, just so you're getting the best rate, the best fees. And when it comes down to rate and fees, and they're pretty much identical, but maybe a little bit off, you got to go with who you feel like is the more knowledgeable person, who you communicate with the best, who you feel like has your best interest at heart. And that's, basically the only way to really decide it. I would tell you more so stay off the internet when trying to find those people. Get a referral. Find somebody that's done a good job for someone and there's a really good chance that your real estate agent has that person. So just, make sure you're dealing with people that have a reputation, something to lose and something to uphold at the same time.
A couple things that I always add to that. I don't ever mind a borrower talking to multiple people. My feeling is the more people they talk to, the better we're going to look. They're going to realize the difference in the conversation we're having, the recommendations we're making, the numbers that we're giving, the tools that we use to help them visualize today and over time what the loan's going to cost and how it's going to benefit them. And the reality is, I am not always the best choice. Jeb, probably the best example, it was just right after COVID broke out on the broker side, most of our jumbo options went away, and you had a buyer that was doing a jumbo loan. We had a conversation that took 2 minutes. I'm like, that's a really good loan you're getting. I mean, here's the things that you want to do. Ask this question, make sure they can do this. You jumped on the same phone call or gave them the same advice and jumped on a call with the loan officer and went through it. And you guys closed on schedule and got really good terms for them. So no lender is always the best option. So my advice is I would never let a realtor choose. If a realtor has a strong recommendation and referral, I would absolutely talk to their person, because there's probably a really good reason why they are referring them. It's not, people always ask, is my realtor getting a kickback? No, it's against the law. It's literally against the law. It's not poor practice or bad form. It is against the law. So if they're getting paid, they're lawbreakers. You shouldn't be working with them either. What they are doing is trying to protect their reputation and make sure that you have as good of an experience as possible. So that's why they're trying to connect you with us. If you already started with someone, still talk to who your realtor referred you to. You have a point of reference and a point of comparison, both for the numbers and the experience.
Yeah, and it doesn't cost you anything. It's just time, right? And if it can save you money, give you a better experience, I definitely think you should do it. So let's see here. So thanks for your time. Is it okay to send the executed contract to multiple lenders? I don't want to lose my earnest money since I have a no mortgage contingency deal. I need to secure a loan. So yeah, you can talk on that if you want.
The biggest thing is, I'm just not sure what the question is to send the contract to multiple lenders. Are we talking about applying with multiple lenders at the same time?
I think maybe he's already in escrow. Maybe doesn't have a lender that he's certain on choosing and trying to figure out best rate, best terms, and looking to kind of send the deal to a couple people to see. So
yeah. So no, you can talk to us, and just sort of relates back to the last question. Talk to multiple people, but I certainly wouldn't double app or apply with 2 different lenders and see, hey, who gets to the end and gets me the better deal. In 24 years of doing this, once or twice we've had a person get all the way, hey, we're ready to get your docs out, and they're like, oh, I was also processing a loan with this person and they can do this. Will you do that? Or hey, if you can get me $2,000 lower, we'll go with you. The reality is, in our business, in the real estate side also, we do all of the work and we don't get paid until it's done. So what that means is proper, respect for the professional that you're going to be working with means doing your due diligence up front and picking who you want to work with, because that person is going to put in 10, 20, 30 hours of work on your file, and not getting paid at the end of that because there was another lender that was also doing that work isn't fair to either one of them. So by all means, if you have a contract, talk to 2 or 3 lenders within a couple days, figure out who has the best deal for you and who you're most comfortable with, and move forward with that one lender.
Got it. And that's and having no mortgage contingency, obviously you need to make that decision sooner rather than later, just so it doesn't come down to the 23rd hour and you've made no decision. So somebody asking about interest rates. So, we'll touch on it just a second, just asking, closing is going to be around March on a new construction property. Do the interest rates increase? So I think you addressed that back towards the beginning. She's thinking about, thinking about locking it now.
His second question there is, hey, the interest rates are higher for a long-term lock. They absolutely are higher for a long-term lock. What I tell anyone is we have to be very confident that rates are going to be increasing before we would do anything longer than a 60-day lock. So if we're looking at, a May closing? So March would get you within 60 days. So the sort of the rule of thumb I would use right now, the 10-year treasury has been between 0.84 and 0.98 or so for going on 2 months now. As long as the 10-year, which you can check on Google, you can check on CNBC, as long as it stays under 1%, I would feel no pressure to lock that loan and push it off as long as you can. If we go above 1% on the 10-year treasury, I would talk to your loan officer about seeing what your options are for a long-term lock and get their feedback at that time.
Got it. Good stuff. Liberty Returns is asking best way to find foreclosures and or REO homes. So, honestly, not right now. I don't know that there is a good way to find these. I mean, there are websites out there that post them. And quite frankly, there's a moratorium, right, on most foreclosures at the moment. So you're not going to see a lot of them populate. But typically what happens is, when a foreclosure actually goes into foreclosure, initially when the notice of default's been filed and they go through that process, they actually have to post these in the newspaper before they actually take it to the courthouse steps and auction off the property. So there are websites that follow all of that activity. Foreclosure.com, I believe, is one of them. There's a couple out there that post this information.
Property Radar, which used to be foreclosureradar.com, is probably your best option. Sean O'Toole, the guy that runs it, is a smart dude. There's lots of good data there. It's the wrong market to be chasing foreclosures. The thing to remember, supply and demand. There is a very tiny supply of foreclosed homes right now, and there's a lot of demand for any home, period. It's what I tell people is, in general, foreclosed homes are not in the best condition. That's not a hard and fast rule, but just in general, someone losing their home isn't taking the greatest care of it. So they generally need work. They're not in tip-top shape, and any discount you're getting is generally not enough to bring it up to the level of where the current market is. So by the time you buy the home, repair and upgrade it and move into it, you haven't saved yourself any money. So it's a tough route to go in the current market of trying to chase it. But if you think it's going there in the future, I would 100% say propertyradar.com is your best option.
No, that was good. Yeah, because I don't want to go down a rabbit hole on that. So asking what information do you need to have for successful closing? So Tanisha, not sure what state you're in, so that's all going to depend on where you're located. In California, you don't really, once your contract is, you're in escrow, escrow is a third party that represents both the buyer and the seller in transactions. They deal with the paperwork throughout the process. So essentially the closing is, when the lender funds the file. You've essentially already done all your documents with escrow. The only thing you have to do is do the documents with the lender. Now, I know in other states, you show up to a closing table, there's an attorney there, you do everything at the office. And so I honestly I don't know enough about that to even be able to tell you what you need in those cases, if there's anything you have to bring to the table at that point. But lastly, I would say wiring the funds is probably the last thing that happens in a transaction after signing the loan doc. So I don't know, Josh, anything to add to that?
No, not really. The purchase side is interesting for us, and I prefer them because once we have an accepted contract, that gives us the roadmap. And generally, the transaction coordinator, Kaylee, in your instance, will send over a nice little here. These are the dates that everything has to happen, and
Right.
then your TC, the other agent, their TC, the escrow officer, and us, the lender. We're working on hitting those timelines. So for the most part, if you've been qualified for your lender, they have all of the information for the successful closing, and then escrow and the agents and the TCs are working on everything else. So it should
Yeah.
all be in your contract by the time you get to that point.
Yeah, exactly. In the state of California, I mean, honestly, the buyer has pretty much done all their due diligence by day 10 in the most, I mean, at this point, at least with the current market. So let's see here. We're getting a lot of thank you for the ones that we've addressed. One of the questions that this comes up quite often talking to different buyers, difference between pre-approval and a pre-qualification.
So if a potential buyer calls me and we have a conversation, pre-qualification is literally as simple as how much money do you make? How much money do you have available for your down payment and closing costs? Who do you owe? What do you think your credit score is? And it's me in the back of the napkin here, plug in some numbers. Here's what you are pre-qualified for. It really means nothing because you could have told me anything. A lot of times, not because they're lying, a borrower will tell me, hey, I make $6,500 a month. You go, okay, cool. Well, they started an Etsy business 3 months ago, and for the 3 months, they've brought in $6,500 a month. So it's really important to take the shift. The pre-qualification is important. It's a good conversation to have because now we've laid a groundwork that, hey, everything we've talked about sounds like you're a good candidate to buy a home and would be qualified for a mortgage. Now the pre-approval is we need to get a complete loan application. We need to get all of the supporting documentation, mainly income and assets. Different types of loans could need different items. But with that, we set up the file, we pull the credit report, we run it through the automated underwriting. We're verifying that the income that you think is your monthly income, which may very well be today's monthly income, we verify that that's the qualifying income that an underwriter is going to use. And we also make sure we're going through the asset statements. Yes, we have the amount of money that we think. It's been there, it's sourced and seasoned. We don't need a gift letter. We don't need to explain where this $100,000 deposit 3 days ago came from. So it's just the difference between a pre-approval is a fully vetted pre-qualification. Pre-qualification, we're just talking it through. Pre-approval is we've gone through and we've documented everything that we need to issue a full pre-approval letter and assure your realtor and the listing agent and the sellers of the home that we're going to have a successful on-time closing.
Got it. And so with that said, if you're thinking about buying a house, pre-approval is the way to go. Make sure the lender's looking at everything, all the documentation, because the last thing you want to do is get in contract and find out, for one, that you don't qualify, right? Because it's an emotional process to start. That's only going to add to it. And secondly, there's certain timelines, deadlines that need to be met. And if you've done your homework up front, the lender has what they need, and it's just a matter of updating a couple of documents in order to get that approval, which makes a much more streamlined process and a lot easier for everyone involved.
Yep.
So we have someone here asking about buying land and building a house in the LA San Fernando Valley area. So, not my market, a little north of us, but what I can tell you is that, land these days sells at a premium because there's a lot of people that want to build property. With that said, construction cost, lumber cost are both very, very high at the moment just because of where things have gone within the last couple of years with new construction and building and what have you. So I would tell you that it's for one, finding a piece of land that you want to buy and that you can afford. I'm not sure your financial position, but it's typically a lot harder than people think it is. And then it's the process of getting plans, going through the city. I mean, the city of LA is not easy to deal with when building a home. I do know that just because you've got earthquake, you've got all of these different things that you have to abide by. So, can it be done? Absolutely. I think it's probably a more stressful process and a lot more difficult process than most people think going into it. Everybody thinks that, hey, I'm just going to go buy a piece of land and build a house, and in North Carolina, where I'm from originally, you can do that. Like, you probably don't even need permits. I don't know what you need. You just buy some wood and a hammer and some nails and you have a house in, a couple of months. California, clearly a lot different process. So Anything to add there on that, Josh?
Yeah, I just look at it from the numbers perspective. So buying land is going to require a bigger down payment than buying a home. It's going to have a higher interest rate, more difficult to qualify for because it doesn't generate income or put shelter over anyone's head. Then you have that carrying cost the entire time that you're going through planning and permitting. Then you have to get a builder to give you a price, commit to a price and a timeline, deliver on that without cost overruns or delays. Then when you're done, you have to put permanent financing on all over the top of that. And for that reason is why custom homes are generally on the high end. Most of the entry, moderate, mid-level homes are done by builders who can buy a large plot of land, put 10, 20, 100 homes on it, and know that their business is to deliver on a timeline at a fixed cost with buyers that they can sell to. And even then, they generally will sell through before they even break ground on them. So it's complex. I would love to build also just because I'm pretty picky and I want something very specific in a home. And you look at the details of it all and you go, we'll try and find one that's already built that meets what we need.
No, absolutely. We got some thank yous again. Appreciate you guys for all tuning in. So we have somebody asking, will the interest on a loan go up if the income is all passive through a real estate distribution because they're retired?
The source of the income will not impact your interest rate. That's not a problem. So if we cannot verify it, so if, for instance, there's a lot of business owners that their tax return shows they make $20,000 a year. You look at their bank statement, $20,000 a month goes in there. If we have a situation like that where we're using alternative documentation like bank statements to qualify, yeah, it's going to be at a higher interest rate. But if it's just a different type of income that we can properly and accurately document, it will not have any impact on your interest rate.
All right, good stuff. Another thank you. Can you guys talk in more detail about a 1031 for fix and flipper? So many of you probably don't know, but Josh did a lot of fixing and flipping in the last little downturn. So he can talk about
The last
1031
monster downturn.
Yeah, exactly. The one that we're going to have next week, I guess.
Just watch some YouTube videos.
Yeah. So yeah, you could talk about that. I mean, rolling the cash into another property, and I mean, we can talk about general 1031s if you know, with that said too. So
yeah, so the 1031 is a like kind exchange. You buy an asset as an investment, and when you sell it, you can push forward into another like kind property or investment and push the taxes forward. You don't avoid them, but you push them forward, which for a fix and flipper,
equal or higher price.
So, and for a fix and flipper, that's beneficial. So rather than you say, I don't want to pay taxes on this $50,000 on a short-term capital gain. If I can roll that forward through 10 sales, maybe I move it to a long-term capital gain. So it can be a good option, especially when you get to larger profit points. If you have $10,000 of profit on a property, it's not an insignificant amount of money, but when you have $1,000 or $2,000 exchange accommodator fee, it's probably not worth the costs. So you just need to look at, am I going to be able to find a replacement property in that timeline? In the current market where things are selling rapidly and at high prices, it may be hard to find another flipping opportunity within your timelines there. As long as you're confident that you can and the profits are big enough that it's beneficial to shelter them from the taxes, it can be a great way to push the taxes forward and hopefully move them to a long-term gain.
Yeah, and while we're on that, I mean, just some of the specifics. So 1031, you have to identify a property within 90 days. 90 days?
Yeah.
45 days, 90 days of closing, and then you have 6 months to close on it. So, you know, you've got to have those opportunities pretty much lined up. I mean, you can't mess around and you know, diddle daddle. You've got to have properties lined up to exchange that money. Otherwise, you could end up with some tax consequences. So,
yeah.
Hope that was helpful. I don't know how much time you have, Josh. So, we're at 38 minutes right now.
We're good. If we got good questions, I'm good.
All right, so got one now about buying now or later. I mean, I don't really want to. Going on to say, want to buy a house. I can't talk. I want to buy a house cash. Can I buy now or wait until next year? So can you? The answer is yes. Either way. Should you is another question, right? So it really depends on your goals, what you're trying to accomplish. You know, this is probably the most common question I get as a real estate agent right now is, should I buy a property or should I wait for the downturn? Should I wait for more property to come on the market? And it's one of those questions that honestly, Josh and myself can't answer. It's, what's in your plan? What are you trying to accomplish? I think if you're, what my go-to answer for most people is that, if you're planning to be in that property for say the next 5+ years, it's a property that you like. In your case, it's going to be cash, so you're not going to have a monthly payment outside of property taxes and insurance and maybe some HOA or whatever, depending on where you're buying it. I don't think you'll regret it. But if you're thinking of buying a property this year and you think that you're going to sell it in 2 years, make some money and buy it, unfortunately, we don't know what the market holds, right? I mean, I think Josh and I are both in lockstep here, thinking that the market's probably going to do a lot of what it did in 2020 in 2021. So you're going to see a market very similar. Most markets are going to appreciate. There's just so much demand. Interest rates are going to stay low. Inventory is low. And then you've got all of these people that are now basically working from home. They're in their property day in and day out. They want a property that they can move around. The people are starting to see all the problems in their houses. You've got people that are in small apartments now wanting bigger houses. I mean, there's so many factors that are playing into this thing. And in addition, you've got people that are no longer have to maybe commute into LA. They can live in Phoenix or Nevada or wherever and still have their same job. So you've got all of these people that are going to continue to buy, in my opinion. So, I can't tell you whether to buy, but I can tell you personal experience is, fortunately I come to an office, but I have a wife and 3 kids in, a property and we're all in there. And the more you're in that property, the more you start to think, I need a bigger property. And, I'm sure I'm not the only one thinking that at this point. And as this continues to progress, I mean, unfortunately, COVID's not going to go away tomorrow, even though there's a vaccine. This is going to play out for probably the next 6 months. And so I think you're going to have a lot of people that are in a similar position to me looking for other opportunities. So I think the housing market's going to continue to follow suit.
And the big piece that comes to me is there's a question behind this question is, are you buying it for an investment or are you buying it to live in? If you're buying to live in and you're going to be there long term, I would buy sooner rather than later, because we think over the next several years, home prices are going to continue to go up at a moderate to high rate. So it's going to get more expensive. You cannot save money unless you're making a ton of money. You cannot save money quickly enough to add to the cash, because to cover the cash price of a home. If you're looking at a $300,000 home and right now you need $300,000, you're trying to get to that point. Well, next year it's going to be $315,000. The year after that, it's $335,000. So it's just hard to do. Now, if it's an investment and you're saying, I want to buy it and flip it, I want to buy it and generate some rents on it, you can look at the timing issue a little more closely. At the end of the day, and I think you do also, Jeb, you feel rates are going to stay low. We have demographic tailwinds behind us. Most areas, home values are going to continue to be stable to increasing, and eventually we will have a downturn. Real estate is, in most markets, especially high-priced markets, cyclical. All cycles come to an end. But when you look at the economic factors and tailwinds we have, I don't think we're going to see that in the next 2 to 3 years.
Agreed. Nomada 504 bought a house in Phoenix, refinanced already, asking about interest rates dropping and being able to refinance again. So we've talked about this one, and asking about a cash out refinance. So
you're more than 6 months past the last refinance. So under the most restrictive terms, you absolutely can refinance now. You said you have about $60,000 of equity in the property. So the question becomes, what percentage is that? If you want to take cash out, you really can't take cash out above 80% loan to value unless you start looking at subordinate financing like a HELOC or a second mortgage. So those are the things that you're looking at there from that end. But if you can lower your rate, I know rates are a good bit lower than where they were in May, I would absolutely roll the rate down whether you can take the cash out or not.
There you go. Awesome. I got some more thank yous here. We got Kevin Fox. Any suggestions in buying in high cost areas? I live in Long Island, New York. So, I don't understand. I guess I need more to the question than just a suggestion in buying in those areas. So, I mean, like Southern California is a high cost area. What I would tell you right now is if you were buying in Southern California, which, I don't know if it's a similar market where you are, but, as a buyer, Make sure you're pre-approved. Make sure your lender has done the due diligence on you to make sure you're fully qualified. Work with a professional real estate agent, somebody that knows the area, knows the market that you're trying to be in, and be patient. I mean, those are really the three things that you need to focus on, right? I mean, because over the next probably, I would say 4 to 6 weeks, you're probably going to see a slow market in some regard. What I mean by slow is that you're going to see less inventory come on the market than you did 6 months ago. It's just that time of year. This is as he mentioned, being cyclical earlier, just a few minutes ago. Our market is cyclical on a yearly basis as well, and so typically the holiday season things slow down. You've got COVID being an extra layer, if you will, on top of an already slow market, and so you're going to have less property coming into the market, which means the buyer demand's not going to go away, but you're just not going to have enough properties to choose from. And when something does come on, you've got a lot of buyers looking for that particular thing. So patience is going to be the key for a lot of people, in my opinion, for the next 6 months to a year. So hope that's helpful.
Yeah, and the only thing I would add to that, Jeb, this isn't specific to Long Island, but you're saying specific to high cost areas. Let's remember that all real estate is local. Jeb and I know a ton about Southern California real estate and California real estate in general. We have a good handle on nationwide trends, but it's important that you have an expert that knows the local market. We're seeing big differences in regional areas based on how the economies are doing. And generally, lower price areas, Jeb and I saw the same data, lower priced areas are doing better than higher cost areas. So it's important to deal with experts that know the numbers where you're looking to buy.
Awesome. Let's see. When houses go down in price, what would you do? Buy several houses with 20% down, or buy a dream? Again, it goes back to what are your goals, right? I mean, if you're going to buy several houses, you're going to need more than 20% down. Typically, an investment property, Josh, you can talk about this, 25% down for investment in most cases, I think.
You can do 20 if it's a single family, 25 if you're looking at units. The thing that I would say is I disagree with the premise. When houses go down in price, yes, eventually they're going to go down, but I would say that if we're looking at the prognosis for the next 3 to 5 years, home values are going to go up another 20% before they drop. So let's say we get a 20% drop, which is no guarantee. They're likely to be no lower than they are today. And while you're waiting, you missed any potential appreciation, any potential pay down. And if these are investments, because we're potentially buying multiple houses, you're just losing time and potential rents on that. So the bigger question is several houses with 20% down, or buy a dream house with a big down payment. These are leveraged investments. So if smaller down payments across a greater number of properties allows you to buy more dollar value of real estate in aggregate over the long haul, 10, 15, 20, 30 years, the more real estate you own with leverage is going to be the greatest return for you. But leverage cuts both ways. I'm not saying go out and, if they were even available, put 0 down and buy 87 houses. A lot of people went broke doing that.
No, no, they did. I had a guy that owned when I did loans, that guy owned like 70 properties. He probably owns 200 now. Absolutely insane. So let's see here. So win the house you love. So Kyle. So guys, if you don't follow Kyle on YouTube, you should. Smart dude, is based in Dayton, Ohio. Got a lot of good stuff on his channel, so check him out. But he's asking, what are some ways buyers can help make agents and loan officers' lives easier? Easier process makes everything smoother. Josh.
What I would say is the easier process we have, the smoother process, the faster, or for our more technologically savvy buyers or borrowers. And the reason why I would say that is it makes it so much easier when you're able to use a secure portal and upload your documentation, when you're comfortable electronically signing documents and going into lender portals. So if you're not technologically savvy, it kind of is what it is. But we have a lot of really cool tools these days. An example is most institutions are able to do asset verification, where instead of providing your loan officer updated bank statements all the way through the process, you log into your bank and authorize them to release the asset verification directly to them. We don't get your password. We don't get access to your account. We get a report that's updated through the process that is exactly what we need to facilitate your loan. So wherever possible, if your loan officer is saying, hey, we have some cool digital tools and here's how we use them and here's how it benefits you, don't be afraid of them. It truly will make your process better.
No, absolutely. Good stuff. And I wasn't even aware of the asset verification thing there. That's pretty cool. So next question we have here, we're gonna go like 3 more questions and we're gonna get done here. We're pushing on an hour. So I'm trying to determine optimal percentage down payment in terms of PMI rate. Does PMI decrease with additional percentage of down payment, or does it happen in discrete intervals?
So it doesn't go off of, so 82% isn't different than 83%, but 85% is different than 90, which is different than 95 and 97. So the 3 big factors that will impact your mortgage insurance rate is which one of those loan to value tiers you hit, your credit score, and then the last one is how many borrowers you have on the home. The more borrowers have proven to be less risk. So me, if I'm a single person, I'm going to pay a higher MI rate than 2 Joshes buying a property together, just because there's less risk. If one loses their job, the other one's still likely to pay. And I guess the last factor that is important in mortgage insurance is debt to income ratio. A higher debt to income ratio is greater risk and will pay a higher MI rate. So if you have 2 borrowers with 800 credit scores and 15% down and a 20% debt to income, they're going to pay a very, very, very low mortgage insurance rate. And conversely, high LTV, single borrower, middle of the road credit score, MI can get pretty excessive.
No, good stuff. Ronald is asking about rates on an FHA putting 3.5% down with a 695 FICO score and a DTI, or a 42% DTI. So I can tell you, Ronald, we don't know loan amount. You don't know whether it's a single family or a condo. So there's some other factors in there I think you would need in order to actually give you a legit rate.
The answer is you're going to get a spectacular rate. FHA with anything above a 680 credit score is very good right now. Jeb was right. Standard balance, high balance will vary, but I would safely say with the information provided, plus or minus 2.5%. And if you want a lender credit, if you want it no cost, if you want to pay points, you can get that thing as low as 2.25, 2.125 if you want to pay some money for it. So let's say plus or minus 2.5%, depending on what you want to pay and whether it's standard balance or high balance.
Got it. We're going to go with this one and one more. So spouse cosign car loan, will it count double in DTI ratio? So I'm assuming they're saying that the spouse cosigned with someone other than the husband. And they're asking if that car loan is going to count in their debt to income ratio. So I think it's, if they can provide proof of 12 months payments that the other person's been paying, then maybe you can deduct it from the DTI. Is that right?
Yep. As long as you can prove that the other person has made the payments for the last 12 months, you can exclude it. If saying, does it count double? It makes me think that maybe husband and wife are both on the loan. No, it doesn't count twice in that instance. Right. We only count the debt one time.
Okay, perfect. And the last one is asking if we know any lenders for USDA loans. So did a video on USDA today. Do me a favor, email myself or Josh here. We'll put some information up on the screen in just a minute, and we'll connect you with somebody. It's definitely, I don't like putting other people's information in comments just because I don't want people to get spammed or for whatever reason. So I'd rather have people just email me, and then I can provide the connection, and you guys can have that conversation from there. So want to add that up there, Josh? I don't know what we have in here, so we'll do this one.
There we go.
2 email addresses there. You can email myself or Josh if you have any questions. There were a couple other comments that came in towards the end. We'll maybe add those to another live. Maybe we'll do one next Wednesday, right before the Christmas break, if Josh is available and we can make the time for it. Any parting words there, my friend?
Not anything other than during the wonderful year of COVID 2020, I have nothing to do but do loans, talk about loans, or come back to work. So we will be available for your viewing pleasure next Wednesday.
Awesome, guys. If you are still here, which I'd be surprised if you are, but do us a favor, hit the like button, show us some love. And as always, we appreciate you guys taking the time and watching, and appreciate the support. We'll see you again soon, guys. Bye-bye.
Thanks, Jeb.
All right.